All right, good morning, good afternoon, good evening, whenever you may be watching this. Hello, I'm Geoff Ziegler, here to discuss my final research paper for business ethics with the OMBA course. My question focused on, should income tax rates be flat? My answer, no. No, they should not be flat, given the research I did, and I've got a couple reasons over here on this side to tell you why. Costly to transition from the current sort of progressive tax setup to any sort of real new flat tax setup. I think that can even sort of be seen with what has transpired here in the last year or two with the Job Cuts and Tax Act, Tax Cuts and Jobs Act. We got charitable donations, mortgage interest effect on the housing market, small business lack of deductions, changes to the retirement environment. Get into discussion around tax earned income and how that impacts lower, middle, upper, and rich. And then we'll even touch on some flat tax related current events that we got going on. So I guess first things, obviously we've had an income tax here for roughly about, 100 years or so, World War I. Obviously they did some stuff back in the Civil War and had a brief one, but the 16th Amendment ultimately allowed them the opportunity to, for Congress, ultimately, truly, to enact an income tax. So, yeah, that's what they've done. And since then, obviously, I'm going to make sure I got my notes correctly here. Since then, the rate's been as low as 28% for the upper tax rate in the late 1980s, and as high as 94% during World War II. Because, in case you didn't realize, war is expensive. So, there we go with that. Get into talking about the idea behind flat tax. Obviously, it kind of touched on Steve Forbes, obviously in 1996 presidential election. He's been a huge proponent of a flat tax. There's been some other folks in the 2012 and 2016 elections, Ted Cruz, Rand Paul, we got Ben Carson, Rick Perry in 2012. There was even Richard Shelby, who was a senator out of Alabama, and Dick Armey, who was a representative, both lined up forces in 1995 and tried to push through what was called the Armey-Shelby Flat Tax Act of 1995. At least in my research, that's as close as we really come to having a full-fledged effort outside of just the presidential candidate sort of spin, if you will, on discussing flat tax. So. If we look at, again, other historical aspects of flat tax, currently there's 8 states in the country that have some sort of flat tax at the state income tax level, including Indiana, right here, Indianapolis, Indiana, where I'm at, including Illinois, which is probably where you may be watching this video from, where Carbondale is located. We'll get into a little bit more on that one in the current events later on. But then looking at others, we got Colorado, Massachusetts, North Carolina, Pennsylvania, Utah. So you've got really a hodgepodge of democratically strong, Republican strong. They're not geographically really located with one another. They didn't all come into the union at the same time. So there's not a lot of commonality there. If we sort of switch to nations and look around the world as far as who currently enforces flat taxes, you can generally very quickly focus on Eastern Europe. A lot of the former Soviet bloc republics have been big proponents, at least over the last 25, 30 years or so, of the flat tax environment. So places like, a lot of what do we got there? Estonia, Bulgaria, Hungary, Lithuania, Romania, Georgia have all enacted, are attempting to enact some version of a flat tax. Again, we'll discuss a little bit further in our video about why that is or isn't a good thing. I guess we can kind of break into now a little bit of why it's been a good thing, or why it was at least. Early 90s, just coming off of the fall of communism. So a lot of these places, a lot of the folks had similar amounts of resources. Again, in a true communist society, nobody has much more than anybody else. So it made it very easy for a lot of these governments that were just sort of coming into their own in their infancy. How are we going to tax our population? Well, everybody's got roughly the same amount of income, same amount of resources. A flat tax makes a lot of sense. That way you can tax everybody the same, because you're roughly going to tax the same amount of resources that everyone has, because coming off of communism, that's what everybody had. So it made perfect sense. We can dive into a little bit later on here whether or not that still is a good thing or not. So, all right, let's dive back in to reasons why I say no to a flat tax. All right, number one, and this isn't specific to flat tax so much as it is to just any sort of drastic change. It's going to be costly to transition it. You've got to obviously update everything in the Department of Treasury, everything in the IRS environment. All those employees of the IRS need to be able to understand how this new tax code is going to work. So they need to just be educated and trained, et cetera, on how to use it. Then there's the idea of you need to be able to discuss anything around, how is the Joe Q taxpayer going to understand what's going on? So what sort of communication, literature, knowledge, education, et cetera, is going to be given to them so that they know what's going to transpire, so that they can make whatever necessary preemptive plans they need to make to ensure that they're not negatively impacted in this flat tax environment. So obviously, we're talking what? We got costly transition here. So we're looking at, we've got, IRS, it's going to cost the IRS a decent amount of money to know what to do it, Joe Q taxpayer, how do you educate, train these individuals to be able to, limit the negative impact. So again, I recognize that, we're not necessarily talking about, how that's unique to flat tax. Again, if we look at, what's the current one called? Make sure I'm calling it the right thing here. The Tax Cuts and Jobs Act, the one that just came out, that we for the first time have really gone through here in 2018 and are currently going through. There's a lot of effort in that space where people, you read these news articles about people being surprised with the lack of tax return that they're getting, and stuff of that nature where they didn't anticipate that being the case. So anytime you're going to go from something as say at least standard for our environment as a progressive tax approach, and you're going to go to something so drastically different as a flat tax, you're going to scare people. Just again, the whole who moved my cheese, what's the change that's going on in the environment? How's it going to impact me? How can I make sure that I'm not going to be negatively impacted by this tax change? That I'm not going to get screwed ultimately, that they're going to take more of the money that was mine than I think they should because I didn't pay attention or I didn't get communicated enough information in advance. So that's what we're talking about there with regards to costly transition. As we move on, and now we're going to talk specifically to flat tax related things, charitable donations. All right, the idea being here with a flat tax, they eliminate all deductions, adjustments, credits. It's all gone. None of that exists anymore in a true flat tax approached environment. There are some iterations of it, that they try to do a bit of this and a bit of that to kind of, mix mosh things. But if we're talking true flat tax, deductions, adjustments, credits, removed, gone. Everything that is earned income is taxable. We'll get into that later. All right, so if we're talking about charitable donations, if I'm, an average taxpayer and I get, I've got a something I'm excited about, be it my church, be it, a civic organization, be it an organization that's doing something for the common good, be it my alma mater, be it just somebody else that's a 501c3 that I think, is worthy of some of my money, some of my resources to try to offer them something up for the betterment of society or for their institution. What do I get out of it? At least right now, I get, the ability to write it off of my taxes. That's changed a bit even, I would say, this year, obviously with the Tax Cuts and Jobs Act, where that standard deduction has gone up to the point where, you go up to, $24,000 now. So it's almost been doubled, at least for a married file jointly group of folks. So, the intent, again, ideally you'd like to think that charitable donation-wise, there would be the desire to go ahead and donate anyway. Obviously, and the tax write-off was a bonus. But if we're looking at, small sample size here, this year, after the standard deduction went up, make sure I'm giving it right here, the Fundraising Effectiveness Project Organization released information that indicated that gifts under $1,000, so like your standard taxpayer is going to be able to do, dropped 4% just this year, 4%. And that was when there still was a standard deduction that depended upon how much you ultimately contributed to and were able to itemize, you might have still been able to take advantage of it. But if we're talking, your average person who might not hit that $24,000 threshold, what incentive do they have? I mean, yeah, they might like it, but at the end of the day, I don't get to write it off my taxes, I might not do it. And apparently, there's a case to that. So if we're talking you eliminate the standard deduction, man, then it's just gonna, I envision that this just, they go down, down, down. I was gonna say, and then how is that impacted? You got all those downstream organizations that rely on, rely on this income, rely on these financial resources to be able to budget and provide for the common good, if we want to even get that generic or that to that level. I mean, go beyond just the schools and their endowments and the churches and their ability to raise funds. I mean, if we're going to the level of helping the homeless, helping the mentally we'll call it handicapped. I guess that may not be the right word, so excuse me for that. If it's the anything in the mental health environment. If it's just the ability for low-income housing, if it's the job creation for folks who just need a little bit of upkeep and a little bit of resources, all these things rely on private donations. And if we don't have those, or we can't give them, or people decide not to, their budget's going to be impacted, and they're suddenly going to have to decide what they need to cut, which is a bad thing, a bad place we want them to be. So there's the impact in the charitable donation space. We move on, and we're looking at mortgage interest. And again, that's a huge one. For me, I'm sure for a lot of people, the ability to write off and deduct the mortgage interest and the real estate taxes, property taxes, on your primary residence. So, I mean, if they were to eliminate that deduction, suddenly that's that much more income that's taxable. That's that much more income that comes out of my pocket. It's that much less likely I'm going to be able to pay that mortgage. It's because of this interest deduction. There's so many people that have been able to afford homes that if you remove it, suddenly they're not going to have that capability, or it's going to be really difficult for them to be able to do it. So what you've done ultimately is you've taken the average, taxpayer, homeowner, et cetera, and you've made it that much more difficult for them to, I guess, really sort of survive. To reach, we'll call it the American dream still. They have a job, have a home, have your 2.1 kids, stuff like that, but have that ability to. One of the reasons you're able to do it is you can deduct it. If you can't, then suddenly, no deduction, which is, I mean, it's a huge deduction. I mean, for some people, it's probably in the 5 digits, I would think, tens of thousands, potentially, depending upon your interest. And you've got these people that are locked into these 15, 20, 30-year mortgages that really, ultimately, if this starts to happen, they've got no way out. Short of, the potential ability to refinance, the potential ability to try to just sell their home, which again goes against that desire of home ownership. And again, if you sort of look at this at a holistic, countrywide issue, it has a tremendous impact on the housing market. Because suddenly, you got all these people that can't afford their homes, they're either being kicked out, or they're deciding they have to sell, so you're selling at, pennies on the dollar, or something of that nature, something less than what their house is actually appraised or worth. So you're talking, there's a major downstream effect on the housing market, which, why? There's no benefit there. Where's the benefit here with doing this? There isn't. I can't at least see it. So again, another reason that there's nothing good that can come out of that. So, all right, moving on. Small business, lack of deductions. Again, we talk about lack of deductions are being removed. Small businesses thrive on that. Working out of the home, got a small office space, just getting started. Again, we're taking entrepreneurship theory and practice as our alternate class. There's a huge discussion around how you set things up, whether you're an LLC or you're a corporation or sole proprietorship or whatever it may be, but there's still discussion about how much can you deduct from your taxes, depending upon if you use it for a business purpose. You remove that lack of deductions, or you remove that ability to deduct, and again, very similar to the housing thing. What you've got is suddenly that's more income that can be taxed from the small business level. That's more that has to be taken out of their profits to be able to account for paying those large taxes. And again, that's a downstream impact. Again, down, down, down. I know I keep harping, very similar, but that's what it is. It's this idea that these small businesses can potentially no longer afford to be able to live if they can't deduct the mileage, the office space, buying the furniture, whatever it may be, stuff like that, the utilities. If they can't do it and that gets compounded on top, on top, on top, yeah, they may have to make such a bad decision as I've just got to, close my business. And if others are seeing this, people who are trying to innovate, who are younger, who want to start their own business, but may just get scared away from doing so. So it may further, if we're talking downstream, impact innovation, impact the ability for just folks to want to do that, because they're going to get scared away from it, because they see what's happening. And then if we talk about everything in the retirement space, again, these businesses, maybe not small businesses, but these other businesses that originally contributed, to your 401k and your 403bs, suddenly, that used to be tax deductible. They used to be able to write that off. Now, again, you eliminate the deductions, the ability to deduct. They don't have that ability. So they're going to think twice about, well, should we still contribute to these or not? Because they're not getting any benefit out of it necessarily from a tax standpoint. So you're going to have, even though it is good employee policy, they may not do it. So suddenly you look at, you've got some people, employees who are working for employers who no longer help fund their retirement. So suddenly these employees have to fund their retirement on their own, as well as they're back up here trying to figure out how they're going to pay for their house that they just got, sort of screwed on from a, can't use mortgage interest. So again, they're getting a double whammy here because of the inability to deduct anything from taxes. So again, I think, this is the type of thing that when you sort of glut it all together, pull it all in together at a holistic, national, countrywide view, there are major impacts to just how the retirement setup is going to work. And suddenly I'm having to foot the bill as opposed to being fortunate enough to have my company or my employer help me. I know we're kind of running up on time here, so we're going to keep going. This is the big one here. Tax earned income only. All right, this is the big one. Big one, big one, big one. All right, the idea being that it's tax on earned income. Has nothing to do with dividends, has nothing to do with interest income, has nothing to do with capital gains. So if I'm somebody who's rich and I've got the ability to potentially go to my investments and live off the resources of the investments, none of that is earned income. It would not be taxed. I'd be in a position to come low or near zero on my taxes simply because I'm able to live off my investments, off of my dividends, off of I got capital gains on property, on just other investments, stocks, etc. Whereas you've got your lower and middle class folks who don't have that luxury, don't have the ability, don't have those resources to be able to do that. So what they're getting taxed on literally is what they have, a lot more than what they have, their earned income. And again, if we're talking about how the upper class and the rich don't pay taxes because they're using, interest-based income, while the government is still expecting revenue, taxes are the largest part of government's revenue. They're still expecting that. Where are they going to get it from? Well, they're not going to get it from these folks because at least the way the laws are written, that's not going to be the case because they won't have it, because they won't have any earned income. So they're going to go downstream. Who's next? Well, your lower class and your middle class individuals are next. So they're going to have to pick up the slack, fill that void, because the government's not going to say, well, we don't need your money. No, they're still budgeting for things. They just need to find somewhere else to get it, and if those are the way the rules are written, then they've got to change it. All right, how are they going to change it? Well, either you're going to change the rules, then it's not a flat tax anymore if you move off of earned income. But what else can you do? You can raise the percentage rate. You can raise the tax rate. Well, who does that sort of end up screwing? Well, it ends up screwing your lower and middle class folks because they're still the ones who don't have that they've got earned income. They don't have that income based on interest. So they're the ones who, you raise it from 17% to 20%, they're the ones who get screwed by it. So it becomes a vicious cycle. They don't get the opportunity to move their income or their resources from a tax or from an earned income standpoint to an investment income standpoint, and therefore try to lower their rate. So, yeah, so again, it's just a vicious cycle. There's no way around it. And again, if they want to call it a true flat tax, that would be the case. If you start adjusting it and account for this, well, then it's not a flat tax anymore. But again, so that's what we're working on. Again, this is the biggest obstacle to it. All this other stuff, obviously, yes, but again, just you're going to tax my earned income, and the people who actually have more than me are going to be taxed less than me? Not going to work. Court of public opinion, not a chance. All right, so lastly, we got about 30 seconds or so, maybe a little bit more than that. We're going to get into talking about current events here with the flat tax. State of Illinois, the new governor, I got to make sure I got his name right here because I'm not there, J.B. Pritzker, wants to move from a flat tax to a more progressive tax, potentially, but a lot of the state government folks are not excited about that. They'd have to change the Constitution, because it's in the state constitution. So who knows how that's going to work, but that's out there. Estonia, I talk about Estonia in my book, or not my book, talk about Estonia in my paper a couple points. They were kind of the poster child, if you will, for the Eastern European setup of flat tax. Here literally this past weekend, they had parliamentary elections, and the far-right Reform Party seems to have won quite a bit, which means they're probably going to end up keeping the flat tax because that Reform Party is pro-Russian. Russia's a big flat tax. Again, we're going back to communism, Soviet, et cetera, et cetera. So when it looked like Estonia, potentially at least the way I've written this, might be moving away from a flat tax environment, parliamentary elections over the weekend appear to potentially indicate otherwise. Last but not least, Armenia. The Prime Minister of Armenia right now seems to think that a flat tax is best for their environment. Again, going with that sort of former Soviet bloc approach. It's being debated back and forth, back and forth. The pro-EU folks don't like it. The pro-Russian folks do. We'll wait and see what happens with that. So again, in summary, I know we're at 21 minutes, at least it's what it says on the clock. No flat tax, costly to transition, charitable donations, mortgage interest, bad idea. All this whole lack of deductions, lack of adjustments, lack of credits are going to end up harming the little man or little woman. And where does that impact you? When we're talking about taxing earned income only. Who does that drastically impact? Your lower and middle class folks who have no ability to ultimately survive off investment income, capital gains, etc. So the rich and the upper class take advantage of the flat tax. The lower and middle class are the ones who get, for lack of better terms, hosed by it. Maybe not the most proper term, but pretty accurate. So those are my thoughts. Thanks for listening. Appreciate the opportunity to do the video, be on the class, all that good kind of stuff. Have a good night. Thanks.